we will be talking about why NIO is under $40 in this video. Basically, we will do a thorough examination of the NIO stock. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my warmest greetings. Hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video like this is posted. So if you're ready, let's get to the video. So what is up with the colossal EV maker? Due to concerns about regulatory crackdowns in China, NIO has sold off significantly. Although this appears to be an exaggerated danger, Chinese politicians want NIO to thrive. NIO combines these strengths with a strong bond and an appealing model lineup to offer above-average growth at a below-average price. At present pricing, slightly above the 52-week low, NIO could be a good buy. Despite its great execution, NIO, like many other Chinese businesses, has recently sold off a large portion of its stock. Their shares have become quite affordable, and investors do not have to be concerned about Chinese regulators. We feel it is in the best interest of the CCP to allow its electronic vehicle player to thrive, as this will prevent them from harming NIO. NIO is well positioned to provide attractive business growth in the near future and trades at a low valuation when compared to other renewable energy companies. So why would the government want to put the company in jeopardy? Electric vehicle stocks, even the largest ones, are quite volatile, thus price swings are to be expected. NIO, on the other hand, has lately seen a sell-off that was out of the ordinary, with shares falling dangerously near to a new 52-week low. So, what is in the works for NIO in terms of stock trading? Shares were trading around 30% below their 52-week high in early November. But after a sharp drop in early December, NIO now trades for less than half of what they were in early 2021. When compared to the share price performance of other electronic vehicle companies, this is a significant drop. Tesla, the largest electric vehicle firm by far in terms of market capitalization, is trading at a greater share price than it was in early 2021, and equities like Lucid Group, Ruby, and Automotive have all outperformed NIO in recent years. That is why NIO is causing concern among investors. A number of variables contribute to NIO's poor performance. Let's have a look at these variables. To begin with, the company was hit hard by the global semiconductor shortage that we've been experiencing this year, with monthly sales falling short of estimates in certain of the summer and fall months. Other electric vehicle companies, such as Tesla, have been less affected by supply chain concerns so far this year. However, we believe that these challenges will be temporary and that NIO will be able to develop its business at a quick rate in the next years, as long as product innovation, branding power, and demand stay robust. The fact that sales forecasts were missed for a few months in 2021 won't matter, nearly as much as a year or a decade later. Such share price decline due to transitory supply chain concerns might likely present good purchasing opportunities. Therefore, there is no reason to be concerned. Chinese macro issues are an even more critical reason in NIO's poor share price performance. Chinese tech companies like Alibaba and Baidu have been hit hard by selling pressures this year, as investors are concerned about a variety of China-specific risks. This appears to be true primarily for investors from Western countries. This year, Chinese regulators have severely harmed some industries, such as online tutoring services, resulting in steep and justified stock drops, such as TAL education. Chinese regulators are also cracking down on some fintech companies, such as the Alibaba-affiliated Ant Group, though the impact on business model is less severe than it was for tutoring businesses. NIO and other Chinese electric vehicle players, on the other hand, have not faced such regulatory repercussions, so market concerns are unfounded for the time being. Chinese leaders have seized the chance and established a clear goal of dominating this massive future market. Of course, this is only possible if Chinese electronic vehicle businesses are not hindered, but rather supported. This is, unsurprisingly, exactly what we are seeing. The Chinese government assists Chinese electronic vehicle players in a variety of ways. Whether it's through direct subsidies or regulations that penalize international competitors like Tesla. We believe that investors do not need to be concerned about Chinese regulators when it comes to electronic vehicle investments because Chinese government agencies and enterprises are working toward a common objective of China becoming the leader in the burgeoning EV field. When it comes to most Chinese tech companies, but especially when it comes to Chinese EV players, regulatory risks appear to be exaggerated. While the market is pricing NIO and other Chinese EV firms as if the government is interested in stifling their expansion, we believe government policies to be a significant positive for Chinese EV players in the future years. It is in China's best interest to develop its own players, particularly those with strong brands and a high-end image, such as NIO, as they appear to be headed for international success. It would be counterproductive to China's strategic aims to harm promising electric vehicle companies like NIO, XPeng, or BYD. As long as China's leadership remains sensible, there is no reason to be concerned about NIO. NIO, which is positioned for great growth but is currently trading at a discount, just released its November delivery numbers, which did not appear to be very impressive. NIO was able to supply 10,900 automobiles during the year, thanks to 106% growth year over year. In comparison to the same period last year, NIO has increased its deliveries by 120% so far this year. This makes NIO one of the fastest growing electric vehicle startups, and thanks to tailwinds like the average sale price, NIO should be able to increase revenue even more this year. Through an agreement announced in May, NIO's manufacturing capacity for Zhangwei Automotive Group output was increased to at least 240,000 vehicles per year, and the company's expansion goals don't stop there. NIO expects to be able to produce 600,000 vehicles per year by the end of 2022, thanks to the completion of NIO Park in H2 of 2022. Note that this does not imply that NIO will produce this many vehicles next year. Capacity in early 2022 will be substantially lower, and ramping up production to the capacity limit would take time. This may be observed in Tesla's China trajectory, for example. NIO is still positioned for enormous expansion for many years to come, with a manufacturing capacity of over 500,000 vehicles in place by the end of next year. Continued market growth in NIO's home market, as well as foreign expansion, will fuel sales. This summer, NIO made its debut in Europe, with Norway becoming the first European country to receive deliveries. By 2024, NIO intends to join all major vehicle markets, including the United States, demonstrating that its entry into Norway was far more than a test balloon. It was the beginning of a bold international expansion strategy. With NIO's high quality and premium brand, the firm is ideally positioned to gain market share in Europe and the United States, where consumers may be hesitant to buy low-cost Chinese products. Those reservations should not be a huge problem for NIO. Featuring new model debuts like the 2022 ET7 sedan, a type of car that should do particularly well in Europe and has garnered really positive feedback. In terms of model lineup, NIO remains robust, with regular new launches ensuring that the selection does not become old. Despite its rapid expansion, NIO is a very inexpensive electric vehicle manufacturer. The stock of NIO is worth 9 times this year's sales and only 5 times next year's. Electric car equities are more volatile than traditional auto stocks, and they aren't cheap. As a result, some investors may decide not to participate in the space at all, which may be a smart decision. Stocks with above average growth, a lower than average valuation compared to other EV players, and realistic plans for future business expansions appear to be the best choice for those seeking exposure to the space. And with that, today's video comes to an end. If you haven't already, hit the like button to show your love and support for the video. Also, don't forget to subscribe to the channel by clicking the subscribe button below. Turn on the notification bell next to it to be the first to know when a new video is posted. Thank you for stopping by to watch, and we hope you had a great time. We hope again to see you soon.